Jeffrey, are you on the line?
I am.
Awesome. Awesome. All right, Jeffrey, I am going to project your slides. Let me know when you can see the screen.
I can see the screen.
Awesome. It's all yours.
Well, before we get started, I just want to wish the fearless leader at Flya, Michael, a continued speedy recovery. He's been a little bit under the weather, and I believe is going to be getting out of the hospital here in the next couple days. And so we just want to wish him well and hope he's continuing to progress nicely. Well, thank you for giving me the opportunity to visit with the folks that decided to come and listen to our perspective on specialty finance and both distressed opportunities and point of origination opportunities that are going to present themselves and continue to present themselves going forward. As we purvey the landscape and we tried to look at the pre-COVID and post-COVID world, first and second quarter and third quarter and fourth quarter are continuing to tell you an interesting story. And, you know, the first quarter with seasonality in many of the assets in specialty finance, with fiscal support from the Fed and the federal government, both fiscally and the Federal Reserve, and it being tax season allowed a lot of things to get kicked the can as we speak down the road. And so as time has moved on, we've seen a recovery in both employment and other characteristics of the economy, but recognize that with that improvement, we still have COVID, and COVID creates uncertainty, and the political environment creates uncertainty. So the certainty of how big or when another stimulus package will come is uncertain at this point. But I think we can all agree we are going to get one, whether it's during the break between presidential leadership or whether it's into the first or second quarter next year. There is going to be stimulus coming. And the question is, with the election in Georgia and Senate control, you know, how much of a COVID bailout will there be? And then how much of an infrastructure investment will there be from the federal government? So those are things that create opportunity in markets because there's opinions on both sides of that discussion. You know, at Sheridan, and I think people in the specialty finance market that have lasted the test of time, when you look at these opportunities, you have to look at the macroeconomic environment somewhat in an agnostic basis, meaning we're obviously aware of liquidity and where we are in the cycle. That has to go into your thought process, but you want to price assets, and if you're buying them, and you want to evaluate the value, if you're lending, to allow you to be in situations that there is enough coverage to allow you to protect your downside exposure and make it a more asymmetrical opportunity set. And so those are the types of things that we try to do, and I think investors or participants in the specialty finance market do if they stay in these markets and flourish, is they adhere to this from a top-down and then a bottoms-up perspective. So we at Sheridan don't think we have all the answers, but what we do think is that family offices and institutions and people, high net worth investors and people that commit capital in this space should look to a manager, a finance company, co-investment partner finance company, somebody who can steward your capital that has seen the ups and downs of cycles, understands the nature of a asymmetrical opportunity where you're protecting downside, where there's upside waiting for you. But I think it's a space that is a little misunderstood, and the experience set and the deal flow opportunities that professional specialty finance firms have, I think is worth the additional compensation that they're paid to be able to help guide investors or participants or co-lenders in transactions. So would you please, with that, would you please give me the next slide? Thank you. Just to give you a little perspective on Sheridan and myself, my partner and I, Chris Morrissey, started the firm back in 2002. We've done over 140 transactions. And when we started out with this, we wanted to figure out how we could differentiate ourselves from just other players that play in this space. And I think the fact that we focus on 4 verticals that other players do, but we focus on senior secured loans to specialty finance companies of all types. We also focus on providing participating debt to distressed debt buyers of financial assets, consumer, commercial, esoteric. We think that understanding the front and the back end of both acquiring or financing point of origination assets or distressed assets gives you an understanding of how the assets need to be serviced and what the value proposition in those are. The third leg is finding novel origination businesses to buy receivables in. And the fourth is buying orphan assets that that allow you to take advantage of distressed opportunities. We also have operating expertise in the specialty finance space. We have a couple of collection operations, that one in the bankruptcy space and one in the probate space, that collect and can acquire receivables in the consumer loan market that are involved with bankruptcy consumers that have filed Chapter 7 or Chapter 13, or decedent consumers that still have obligations at institutions. And recently this year, we also provided a solution for a bankruptcy trustee in helping liquidate a high yield consumer loan portfolio. So we think that sort of combination of experiences gives us a unique perspective in how to evaluate situations in this space. It also has created a tremendous origination channel, which is, I think, as investors or participants, what you're paying for specialty finance people is the ability to find opportunities that might not be widely distributed. So that and experience on the transactional side, we think those are the things you need to look at, whether it's Sheridan or somebody else. Can you turn to the next slide, please?
Do you see the newest one up?
I sure can, thank you. The sort of next thing in underwriting these different partners, which is one of the things we want to add value to your perspective today, is you want people that have been through cycles. They understand how different types of assets perform, because different cycle downturns have different drivers and different reasons why they happen. So one wants to choose partners that understand different cycles and how they've affected these assets. You want to make sure that people have good legal and compliance and regulatory relationships that they've had over a period of time, because job one is compliance and regulatory. You want to make sure you have good value companies that have good valuation partners, because you want to value those assets in the real world, not in the fictitious world. You want to make sure that their reporting and their ability to report transparently and in timely fashion is strong. Those things, and you want to make sure that when they do look at value, that they're looking at value through realistic and proven exit strategies, which will give you a better perspective on what you really own and what's really being financed. Can you go to the next one, please? Thank you. The other thing you want to do is make sure you understand the structure you're in. Are you senior? Are you mezz? Are you preferred? Are all the bells and whistles in place if it's a senior transaction? Do you understand the nature of a counterparty loan versus an SPV? Those are all critical things. Do you understand what components of an SPV transaction you need? Do you need, depending on the transaction, do you want bankruptcy remoteness? Do you want a non-consolidation opinion? Do you want separateness? So the reason you do an SPV structure is so you don't get caught up in bankruptcy. So you want to make sure those vendor relationships that your co-investor or your manager have understand the vagaries and the different flavors of being secured in a bankruptcy situation. You want to know, are you going to be involved in participations? Or participations in senior loans are fine, they're proven, but it's a little bit different asset to finance. If you're trying to get leverage, it's a little bit different structure versus having a senior loan interest in an asset. These little nuancy things are critical in you being secured and you understanding what the risk profile is. Is it a sponsored or non-sponsored transaction? So these are some of the things, the nuances that you need to price as somebody who wants to invest in these types of opportunities. Can you, would you please go to the next one? Thank you. When you're looking at these opportunities, you need to have a process that's efficient. And when you have an efficient process, you need to be able to, on a very quick and timely basis, figure out if it's worth continuing the process. So it's looking at who brought you the transaction, the counterparty, which as you do this and do repeatable transactions, you get a feel of who is real and who's not when they're bringing you transactions, or direct to the company directly. You're also going to quickly do a cash flow model and project cash flows and collateral values and figure out if you can get the risk reward return that you're looking for. And you're going to stress those things. And then you're going to quickly disseminate pricing and whether you can get the pricing you want. And then you're going to go back and try to take the transaction off the market and get a transaction done. And being transparent and getting a reputation of not baiting and switching is one of the critical things of creating a value chain where people look at you as a first call. We don't bait and switch. We don't do transactions, give them different terms, and then change the terms once we get them into the process. We look to give them a honest recognition of where we think the value is for us. And we sort of, in a kidding way, tell them we're not Costco, we're Neiman Marcus. And so we put a fair bid depending on the size of the transaction, whether you need to get an illiquidity premium or not. But I think being straight up and transparent with people that bring you transactions, because most of the transactions we do are either from past employees, accountants, lawyers, vendors, other parties, other lenders, other funds. And so you want to get a reputation of giving them a honest pricing profile so they're not figuring they're wasting the time when they call you. Can you turn to the next slide, please? Thank you. I think the question that brings to us when we look at deals is, do we think there's, based on the cash flows and collateral and sponsor and the profile of the transaction, are we willing to buy the receivables or the loans or be a liquidity provider that way, or do we want to lend and get some credit enhancement in front of us to protect us to have an asymmetrical opportunity? And that's one of the things you need to do in your process so that you can offer multiple solutions to somebody who brings you a transaction, which will give you more bites of the apple and more opportunity. But one needs to evaluate using those as some of the different inputs you're going to get to decide, does it make sense or doesn't it make sense? And does it make sense as a financing, where if I can get first loss capital, which means the seller or the counterparty is willing to put up money in front of us and take the first loss? Well, there's things you can do to put mitigants in place to find a solution to get a transaction done. So, but that takes experience and flexibility. You want to go to the next slide, please? As we stated before, compliance, 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 regulatory, regulatory, regulatory. Licensing, state, federal. Do you have the right vendor partners? Have you had experience with them? Do you know their experience? Have you gotten reference? Each space, commercial or consumer or esoteric, has different issues. Must look at this first, and not just when you diligence it and put the capital on, but on a quarterly basis, making sure that you're doing compliance and regulatory, not just financial review, to make sure that you're not going to be in the soup. Because when the compliance and regulatory issue comes up, you must be proactive, not reactive, and you must be ahead of it. Next, please. The other aspect that you need to be aware of is tax. Are you using cost recovery or level yield method? Is it a depreciable asset? Is it not a depreciable asset? Are you doing equipment? Are you doing real estate? Are you doing chattel? Are there things you can do to have a better tax affected outcome? Those are all things that you need to do to maximize the return profile for your partners. And then having consistent relationships with legal, whether legal is your corporate counsel, your tax counsel, your transactional counsel on a purchase and sale agreement, or a lending document where they understand it's senior or mezz or sub debt, and understanding what your rights are in each one of those and pricing those accordingly, and having the right reps and warranties and covenants in place. Making sure you have the right forensic accounting infrastructure to make sure every transaction we do here, we do bottoms up. We follow the cash to the contract to make sure that at least we're seeing that we've matched off the cash to this point. And then on an ongoing basis, quarterly, we don't do an audit, but we do a forensic review also to make sure that the receivables and cash are being accounted for. So regulatory and compliance and financial is critical to make sure on a quarterly basis that, hey, we didn't do all the work to put the capital on. We're doing it on an ongoing basis. Can you do the next one, please? Again, this is just a continuance of making sure that we're doing all the appropriate things one needs to do to evaluate collateral on a third-party basis to verify collateral. Are you using quick sale? Are you using orderly? What are you using, and what experience set do you have or does your partner have in liquidating these types of assets? And what kind of financial statement review and what kind of legal due diligence do you need to do on those types of assets to make sure you're perfected? Because, you know, if you're going to be in the specialty finance space, making sure you understand how to perfect your security interest and how to make sure that you know where you are in the pecking order is critical. Is, again, job number 1 and 2 with compliance and regulatory. Can we have the next one, please? Having control of the collateral and choosing the right custodial agreement and making sure the documentation and the structure, the devil's in the details. People will try to be sneaky with language that they'll put in a security agreement or a loan document. Commercial reasonability, things where if you're not an expert, you won't know if your rights are being watered down or not based on little points of language that's put into the document that you might miss. Again, supporting why, whether it's Sheridan or anybody else, you want to have experienced partners when you're doing these transactions. And closing and funding procedures. Sounds simple, but having DACAs in place, control account agreements, and how is the relationship of funding done? When do you fund? What is the sequence of funding? Who funds? All those things are critical. And again, love to talk to anybody who wants to talk about those on an individual basis, but your funding and closing procedures on a transaction by transaction basis is not just a simple matter. It's a matter of having a policy and procedure depending on the vertical that you're doing it and doing it well and doing it from experience. Next one, please. And I think we've already mentioned, but diligence doesn't, and oversight doesn't stop when you put the transaction on. That's when it begins. Because I sort of look at these transactions like when you have children in high school and you go away for 2 days and you say, well, you're old enough to stay at home. But I come from a perspective where one needs to make sure that we trust, but we verify. And so whether it's making sure there's not a keg party at your house when you're not home, to making sure that who you're extending credit to or buying assets and they're servicing them for you, that they know you're always watching, that they know that we're not always going to tell them when we're going to communicate or require information to make sure they're not comfortable. I'm an old college football and high school football coach. And one thing my coach in college always taught me, in practice, you want people to be uncomfortable. You want them always to be uncomfortable. So when they get in a game, being in a game is a point in time where they are comfortable because you've prepared them appropriately so that uncomfortable situations in practice allow us to have comfortable situations on the field. And as I've said before in this discussion, periodic and projected measurements. We look at actual versus projected historically when we put the transaction on, and we continue to model that as we move forward. Can we have the next one, please? Here now is an example of a transaction in the plaintiff personal injury space. And, you know, again, like any space, we think it's a very interesting space and we're active in it. But you have to have some experience in it. And so knowing how the finance company, the originator, is advancing to that consumer, knowing that the average advance rate should be 10% of what you think the projected insurance proceeds are. You know, knowing that you're going to get a third of the proceeds because the medical is going to get a third and the contingency law firm is going to get a third. Understanding the servicing relationship, and not like a scheduled P&I payment in a mortgage, understanding what is the frequency of communication you need to have with these companies. Understanding that credit losses are one thing, but understanding and tracking the attorneys that are the plaintiff attorneys in these matters, knowing what their behavior is when they come back and ask you to negotiate the settlement. Are you willing to take less? Understanding the guys that cram you down and try to take advantage of you. So understanding and the eligibility, what specific types of litigation finance accounts are you willing to take in the portfolio relative to the liquidity profile? Because are they smaller advances where the matters get settled quickly because the insurance companies have a threshold where they'll settle smaller matters quicker? Are they motor vehicle, bread and butter motor vehicle cases, or is it somebody who's trying to combine them with larger transactions that take longer or have less certainty because they need footings to finance their business? So you need to understand all those functionalities, and then from there, understanding how to perfect your security interest, and then decide, does this originator have enough static pool history where I'm really comfortable, and the type of case makeup, I'm really comfortable just buying these and getting the maximum yield, or do I want credit enhancement, as an example, first loss capital, to protect me from downside to have an asymmetrical bet? We like the non-correlated nature to this. We like the spread of risk, and litigation finance is an important part of our business, and it's going to be an important part going forward. Can we have the next one, please? The next opportunity we're going to talk about is just distressed residential loans. And we will finance distressed residential assets or buy distressed residential assets with a partner. But again, we're not interested in doing sort of the run-of-the-mill portfolio sale from a large bank at a single-digit IRR because there's strong securitization financing for NPLs. We want to find differentiation areas in that market to find where there's value. And even though there's a lot of liquidity and the housing fundamentals are good right now, there are still illiquidity imbalances that lenders have and other owners that allow you to take advantage of opportunities that still have what we consider really good risk-reward components to it. But again, whether you're buying first lien mortgages, whether you're taking a lender out and buying the debt, whether you're lending to a fix and flip lender, whether you're buying a pool of defaulted second mortgages, all these, whether you're buying first lien, small balance, single family, knowing that is a non-foreclosure game because the balances are too low and the expenses are too high, that's a payment history game.
Hello?
All those things are important when evaluating what kinds of transactions you want to do. And in the transaction example here, we had a very strong sponsor who had great experience where we had first loss capital. And that first loss capital, we bought that transaction in 2007. And the reason we're using that example is because we wanted to show you that we knew we were long in the tooth as far as where assets were being priced, but we wanted to make sure that we had downside protection, and we ended up getting a 7% return on that transaction. Can we go to the next slide, please?
We're actually out of time, and we have to move on to the next panel. We can definitely connect anyone who would like to be connected with you. Just message us, or you can message Jeffrey directly, and we'll pass those along to you. Okay?
Yeah, let me just finish up by saying thank you to Flyer for the opportunity.
Mm-hmm.
And we're seeing a number of opportunity sets in the different specialty finance verticals, both at the point of origination and in distressed asset acquisition. So thank you for taking the time. And I hope these are types of things that add some value to your day when judging who you're going to try to do transactions with to help you protect your downside. Thank you, and everybody's family, please stay healthy and have a great day.
Thank you, Jeffrey.